Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Dan Schwartzman. Doug Krisner has the day off. Asian equities opened higher, tracking Friday's gains in U.S. stocks that helped intensify bets for a strong finish to the year. Hopes for a year-end rally have grown as dip buyers late last week helped equities recover from a slide driven by doubts over AI exuberance and the scope for Federal Reserve easing. For more on the market action, we turn to Vasu Menon, Managing Director for Investment Strategy at OCBC. He spoke to Bloomberg's Annabelle Droulers.
I think one of the key questions for investors, big questions, is are we setting up for the Santa Claus rally?
Well, that's a hard one because we've had a very strong rally already so far this year. Global equities up something like 19%, if I'm not mistaken. US equities 16%. And if you look at Asia and Europe and China, for example, in US dollar terms, they've gone up more than 25% each. So we've had a very strong rally. I wouldn't be surprised if we close the year on a slightly higher note. But I think 2026 is going to be a challenging year. But we remain positive on the outlook for 2026. We think that at the end of 2026, markets will be higher than what they are at the end of 2025. But the next couple of weeks, as you said, the Santa Claus rally, that's a hard one to predict. But I wouldn't be surprised if the markets actually end the year on a higher note because, we've had quite a number of tailwinds helping the markets to actually scale new heights in recent days and weeks.
Yeah, let's talk about the state of play this year, because we've got a chart actually where we can see just the sheer underperformance of US equities versus their global peers in 2025. We don't see that too often, I think really 3 times in the last decade or so. Do you see also that being replicated next year, or do you think that you can actually see US stocks starting to outpace those from elsewhere?
Well, I wouldn't be surprised if US stocks continue to underperform other regions. My own sense is that, fund managers, global fund managers appear to be more receptive to opportunities in Asia ex-Japan, in Europe. And I think that is also borne out in the valuation data, and I was looking at the valuation data on Bloomberg terminals before I came for the show. And if you look at the MSCI USA index or the S&P 500 index, which measures the US stock market in terms of forward PE ratio, it's trading close to 2 times standard deviation over a 10-year history. In comparison, if you look at Asia ex-Japan, you look at Europe, for example, they are trading below 1 standard deviation. So in terms of valuations, you see better value in other regions outside the US. So I wouldn't be surprised if the US stock market continues to underperform in 2026 as money rotates out of the US into other regions.
Yeah, you mentioned some of those challenges that stocks might have next year. Which are the big ones that you're looking at, do you think?
Well, one of the key challenges I think we'll be looking out for in 2026 would be how Trump deals with the Federal Reserve and Fed independence. I think that's going to come to the forefront as Jerome Powell steps down in May and as Lisa Cook's, trial in the Supreme Court. The outcome will actually also determine market perception about Fed independence. So Fed independence is going to be quite critical, we think, in 2026. And how Trump deals with it, I think, will be quite important. And of course, the US midterm elections at the end of next year, in the run-up to it, you could see geopolitical risks go up, a greater US-China tension. That could also, figure on how the markets perform. But overall, we think there are more tailwinds than headwinds in 2026. And the market should still end the year on a higher note despite volatility, as you saw in 2025. 2025 is a very volatile year, but still, the markets are going to end the year on a pretty strong note. I think you're going to see the same story play out in 2026. There'll be challenges and headwinds, as I mentioned, but I think the markets will be able to overcome them and still close on a higher note at the end of next year.
Do you think markets have fully appreciated as well that risk that we at least see maybe the end of easing cycles, even the start of tightening cycles once again? I mean, that's a factor we've been talking about, maybe being a little bit underappreciated by investors right now.
Well, I think, yes, it is starting to come to the forefront to some extent. The markets are starting to worry about the Bank of Canada, the RBA, the ECB even, possibly hiking rates. But I think it's still a bit premature. It looks like the Fed will probably continue to cut interest rates in 2026 at least one time. And I think the Fed is a key part of the whole global equation. And the Fed, we think, is going to continue easing. I don't think the Fed is going to tighten anytime soon. And other central banks like the ECB, for example, they have signaled, but I don't think they're ready to tighten anytime yet. I think that could be a story that could come into play in the second half of 2026. But even then, I don't think there's a lot of latitude for central banks to tighten in a big way, because there are global headwinds as far as economic growth is concerned. So there could be some signals from central banks, but whether they're ready to move and derail the global economic recovery and financial market recovery, I'm not sure if they're ready to do that right now. But in any case, I think it's more a story for the latter half of 2026.
What's your expectation around China as well for next year? We've seen again those issues or concerns around the economic weakness coming to the forefront for equities once again. But at the same time, obviously the dominant theme for this year has been that tech and innovation-led story. And you see the CSI 300, for instance, up around 40% so far, or on an annualized basis. But still, what's your expectation for where we go for next year?
Well, we are positive on China. China is one of our stronger conviction calls. We are positive on Asia ex Japan. And within Asia ex Japan, China is one of our strong conviction calls. And as you said, the Chinese economy is not doing fantastically well. In 2025, that was a story as well. The economy faced a great deal of challenges. But look at the stock market. It's done exceptionally well. The MSCI China index is up 30% year to date. So it's outperformed the US in a big way, almost double the performance of the US stock market in terms of the MSCI USA index. So we think that China will continue to perform in 2026 as well. The potential for fiscal stimulus, monetary stimulus, valuations are not expensive, and Chinese households have a huge amount of savings. More than $20 trillion in savings. That's got to find a home, and that could, and not just that. I think global fund managers are also starting to put more money into China, and so put all that together, it means that the Chinese stock market has more upside. Again, it will not be a straight line climb; it'll be volatile, but we think that there's more upside.
That was Vasu Menon, Managing Director for Investment Strategy at OCBC, speaking to Bloomberg's Annabelle Droulers. Coming up on the Daybreak Asia podcast, we get an outlook on Chinese equities. We'll hear from Yan Wang, Macro Chief EM and China Strategist at Alpine. Welcome back to the Daybreak Asia podcast. I'm Dan Schwartzman. Doug Krisner has a day off. More Threads technology introduced a new generation of chips to reduce dependence on Nvidia's hardware. This comes as Chinese chip makers are in the spotlight as authorities push forward with efforts to develop a world-class semiconductor sector. And we get a macro outlook on the markets from Yan Wang, Macro Chief EM and China Strategist at Alpine. He spoke to Bloomberg's David Ingles.
I know, and let me just make reference to your note about 6 weeks ago, first or second week of November, where you did observe, of course, China is hot again. You've been on this whirlwind global tour speaking to investors, including, I should mention, of course, here, Hong Kong, China, and Singapore. What's your overall sense of what people are looking for in the China story going into next year?
I think the biggest takeaway is that global investors are becoming more interested in China again. In 2023 and 2024, China was deemed as uninvestable. Back then, the economy was bad, geopolitical situation was bad, the market was not really performing, so people were not really interested in China at all. But in my recent trips, in my meetings with clients, with investors, I can get the sense that investors are becoming more interested in China. China is back on the radar, and I think this is a very important change because people are still very, very underweight China. So if they are interested in China raising exposure from a very low starting point, I think that can drive a lot of capital inflow into the Chinese equity market. So I think the biggest question mark, obviously, is the market has gone up a lot, right? So actually the market bottomed February 2024. So the market has been rising for over 2 years, almost 2 years. So the question is whether investors should chase the market because they didn't really have any exposure at all. So now the market just keep rising. So I think the biggest concern is whether going into 2026, whether the bull market can continue.
And what, in your sense, what do you suspect will be the... So we know about the lack of inflation story. We know about, liquidity, abundant liquidity that has managed to offset most, if not all, of the former story. And I'm curious to hear what you think in terms of the big question marks and what resolves itself going into next year.
Well, I think really the biggest change since last year is probably investors began to realize China is it's almost imperative to invest in this kind of G2 world, right? So, for example, you mentioned the Chinese chip makers. So all of a sudden, you see Chinese companies are making very advanced chips. A few years ago, that's unthinkable. So regardless of this story, regardless the cyclical profile of the Chinese economy, now you do have two systems parallel to each other. One is the U.S. system, the other is the Chinese system. So I think now people began to realize that every investor has had so much exposure to the U.S. market, but has so little exposure to the Chinese market. So I think this kind of very lopsided allocation is one of the most important incentives for investors to look at China. For example, at the beginning of the year, we had DeepSeek moment. That's when really began to draw global investors' attention on China, not just focusing on the weaker part of the economy, not just the real estate market deflation, but also there are a lot of growth sectors. So I think that's really driving a lot of attentions, also a lot of capital inflows.
And is that distinction visible between the groups of investors that are more familiar with the Chinese market, let's call them domestic players, of course, the home bias, and how does that story, how is the appreciation of that story, how does it change as you look further away from China?
So I think the China uninvestable story was mainly concentrated in the U.S., among U.S. investors and some European investors.
Okay.
So because most of it was because of geopolitical tensions, geopolitical environment, and for European investors, China's role in the U.S.-Russia-Ukraine war, China was deemed very unfriendly. I think that was I remember in those years when I was talking to investors, even though these investors, they didn't share the gloomy views on China, but they were concerned about so-called reputational risk of investing in China. So I think now this is gradually changing. In Asia, in EM, investors' view on China have always been more nuanced.
Yeah. Okay. So the common denominator going into next year, globally, and you have an EM mandate too, is it does seem like the tailwinds from easy monetary policy will somewhat not be as big a part of the conversation next year, as most central banks either pause or have ended their easing cycle. How do we distill the tailwinds coming through out of looser policy, and what does it mean for the weaker dollar story, which has helped, and appetite for EM assets next year?
Yeah, I think the dollar is a big story. I think if the dollar continues to weaken, then obviously global investors' interest on EM assets will increase. So I think that can still be a factor. On the other hand, I think the Fed will continue to ease. We believe the U.S. inflation will continue to fall, so that will allow the Fed to ease. And then you see a lot of EM countries, their real interest rates are still very, very high, right? So I don't think the monetary easing tailwind will diminish much next year, especially for a lot of high-yielding EM countries, especially like in Latam and South Africa. In China, the monetary easing may not be a big story, but a lot of the major headwinds that we have had this year will diminish, right? So housing has been in such a long, deep slump. Consumer confidence has been so weak for so long, and Chinese exports to the U.S. this year contracted a lot. So these are really the major headwinds for the Chinese economy this year. But most likely going into next year, all these three negative factors will either stabilize or even improve. So I think on the China front, I don't really think monetary policy easing will play an important role, because the problem now is demand for loans is very weak. It's not the price. It's not interest rate is not affordable. Its demand is weak. But if these three headwinds will gradually turn into some kind of tailwind, then I think the Chinese economy will perform a lot better.
That's a big if, and I'm glad we end on that. Can I just ask you a little bit more on the housing market and consumer confidence? We know if that goes away, it doesn't matter if the PBOC is tightening interest rates. The market will rally if those two things recover. What gives you the confidence, apart from base effects, that the housing market and consumer confidence will be a better story in 2026?
Right. I think the consumer story is probably easier to tell because if we look at over the past 2 years, there was this kind of self-feeding vicious circle between the corporate sector and the consumer sector. The corporate sector was not hiring, so consumer confidence was weak. And then consumer confidence weak, demand was weak, then corporate sector was not hiring. So now you have this kind of very vicious circle between these two, self-feeding. But now we are beginning to see some evidence that corporate sector hiring's intention began to improve. So across the board, even when I was in China talking to to the business community, my sense is confidence is slightly better than my previous trips. So I think if that changes, I do think there are high odds of this being changed. Then the vicious feedback loop between the corporate sector and consumer sector will begin to reverse. So I think that's, to me, I think that's a kind of higher odds event. On the housing sector, the simple fact is the housing sector has contracted for over 4 years. Housing starts have contracted by over 70-80%. So nothing falls forever, right? So I think that's why even we do not consider this kind of base effect, I suspect we are very close. We are a lot closer to the bottom.
That was Yan Wang, macro chief EM and China strategist at Alpine, speaking to Bloomberg's David Ingles.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.